introduction. It's a pleasure to be here. So, as you heard, I'm based in London. I head up Savills World Research function, so I get to look at the big trends shaping global real estate markets, and there's certainly plenty of those at play at the moment. In terms of my presentation, a couple of parts to it. I'm going to start by talking about recent global market performance, just to kind of set the scene. Then I'll give the near-term outlook, so what's going to happen in 2024, what we think will happen. And then I'll touch on some of those kind of broader macro themes that will impact both next year, but also the years to follow. Actually, speaking of big trends, what we've actually just done recently is attempt to value all of global real estate. As a bit of a scene setter, I'll just touch on this briefly. So 380 trillion US dollars, that's what we calculated the total value of real estate in 2022. 2/3 of that is residential, and combined, this is the world's biggest store of wealth. So this is an important sector. And to put that into comparison, it's worth more than equities and debt securities combined. And gold, something we associate with a safe store of wealth, is actually only 3% of total property value. And global GDP, by comparison, property is more than 4 times that value as well, almost 4 times. So again, as a kind of a bit of a scene setter, looking at how the whole sector's performed in recent years. So this is the 3 years to the end of 2022, and actually we saw growth of 19% over that period as a whole, second only to gold in the case of residential real estate. Now, clearly, things have since changed. We've come out of the very low interest rate environment, and I'll touch on some of that shortly. But to kind of bring it up to date and what's been happening, first of all, in terms of total real estate investment volumes. As we know, volumes are down around 50% on the year, back to around 2013 levels. And this has been driven by economic uncertainty, that higher interest rate environment we now find ourselves in. That falls are consistent across the board. So again, this is global volumes by sector, ranging from around 40 to 60% falls. So most acute in offices, and I'll touch on this again in a moment, but led particularly by the US, very sort of publicised difficulties there that I'll come to. Living also down off a bit of a boom that had happened in the US. And industrial really returning to the sort of pre-crisis levels. Slightly more positive for retail and hotel. I think having seen a bit of repricing that predates the current cycle, as well as comparatively stronger story for physical retail and consumer spending as a whole. So at the regional level, just to give the picture, actually, again, Asia Pacific has a slightly more positive story, so still down, but 48% year on year relative to the other regions. So that kind of sets the scene. The question then is, where are we headed in 2024? Well, firstly, the good news is that inflation has now peaked, and that should mean we start to see rates plateau, having risen to these recent highs, and some possible rate cuts starting in the US, possibly sort of towards the end of next year. Of course, the other factor at play is the economic outlook, and the prospects for that has been changing quite frequently, which this chart sort of shows a lot to take in here, but I think it's worth dwelling on. So these are consensus GDP forecasts by the month that they were published, starting in 2022, and it sort of shows the trajectory of the last few years. So beginning of 2022, things were looking more positive. The view was that inflation was transitory. Then we saw the war in Ukraine, the subsequent energy price crisis, that really dipped sentiment. Beginning of this year, we had the reopening of China. Things started to pick up again, and I think now we're sort of headed towards that sort of consensus of a soft landing. So, higher for longer. On the plus side, we've got relative resilience of household and corporate balance sheets, a recovery in real wages. But on the challenges side, we've got the higher interest rate environment, and that's all going to result in sub-trend growth globally under 3% next year. Question then is, what does this mean for investment globally? So this is actually from a survey of our European and Middle Eastern investors. Interesting to show that the sentiment has shifted, partly because we're seeing, just wait for that to come back. Sorry. The sentiment is becoming a bit more active, so we're seeing more aggressive strategies. Of course, that could mean lots of different things, but one thing it does hopefully mean is that investors aren't just sitting on their hands. So we should start to see a return of more investment activity. We've also surveyed our research network to assess what's going to happen next year at a country level. This is the aggregate of that survey. Again, a bit to digest here. I guess the first thing to understand is that there's more green than red, which is positive. But the balance on the investment side is that we expect to see more markets reporting a stable or moderate improvement in investment activity next year, especially in EMEA. Only secondary offices expecting sharper falls in some markets. And that's echoed in the outlook for rents, particularly more positive outlook for multifamily and residential and logistics. The outlook for prime offices comparatively more positive than the secondary offices, and retail on the more positive side, particularly in the case of Asia Pacific. So this all then points to kind of where we see the market pivoting, and I think the consensus sits around the third quarter of next year. Quite a bit of variation around this. You've got some markets like the UAE, which are much further ahead of the curve, some further behind, but that's where we see the balance sitting. So that's the kind of the near-term economic drivers, prospects for next year. Of course, there's all sorts of other factors at play, lots happening in the world, and I'll turn now to some of those macro themes that we see shaping real estate next year, but also the years to come. And it's kind of worth reiterating the change we've seen in the world in the last few years, obviously with the pandemic, and there's been a real kind of reassessment of the purpose of property and the role that it plays. Of course, property is where we live, work and play. It's where we shop and produce and distribute goods. But the shifts happening mean that there's both a challenge and I think an opportunity for the industry. So we've kind of grouped these factors driving the change into a couple of areas, namely economic, and I've touched on those really impacting that near-term outlook, demographic and behavioural, technological, geopolitical and environmental. To start with demographic, and there's been some really interesting landmarks reached in the world in the last year or so. So the global population reached 8 billion people for the first time last year. We actually saw India overtake China as the world's most populous country. At the same time, Generation Z became the largest demographic group on Earth. And this is relevant because they have particular needs and wants. They're also entering the workforce at scale. That has implications for office markets. And looking ahead, much further ahead, just 9 countries are forecast to account for half of global population growth through to 2050. And interestingly, only one of those, the US, is in the developed world. So there's a real shift in balance in terms of future global growth. Now, of course, it's not just about growth, it's how the balance of that growth sits. And we've looked at the broader demographic change around youthfulness and aging populations. And this map kind of summarizes that at a country level. The darker colors represent aged countries, if you like, in 10 years' time. So no surprise to see China there, the US, of course, Europe, not surprising. But I've layered on top cities. So in green, you've got aged cities in 10 years' time. So you've got your sort of Japanese cities, various European centres. I think the interesting one, though, are the youthful centres in 10 years' time. So places that will remain overall more youthful. So you've got a couple of Chinese cities in spite of ageing populations as a whole. Quite a few of the Middle Eastern cities, a big migration story there. But interestingly, in the West, particularly, you've got some of these sort of smaller centres driven by the knowledge economy, where you've got some sort of strong migration stories. Side note on Singapore, it's not in this is only the top 100, so it isn't in the top 100 of either, but is leaning slightly more to that aged demographic. So businesses want to be where the brains congregate, and this relates to that point I was making about youthful populations and where they are growing. And clearly education, higher education plays a role in attracting those individuals, in developing economies in those places. And we're seeing a lot of investment in the higher education sector. This is just one way of looking at that. We've looked at the count of science journal articles published in different countries, and you can see China has sort of leapt up in the last couple of years following very strong investment in their higher education sector. And we see this echoed in some work we do on tech cities. So we quantify the world's top tech cities based on venture capital investment, attractiveness to business, quality of life, cost, etc. Of course, you've got your typical sort of US tech cities at the top of the list. But in the last sort of 5, 6, 7 years we've been doing this, we've seen more Asian centres move up the list, particularly Chinese centres. Singapore, they're in 12th. We have a fintech index specifically that has Singapore in 4th. But again, interesting to note that you've got some comparatively smaller cities, again in the West. So Raleigh-Durham, Berlin, Austin's in there as well. Again, these sort of smaller knowledge hubs that are really growing, of course, in turn, driving demand for real estate as well. So technology is shaping our world. At a city level, we are also seeing it impacts very significantly in terms of how we live, work and play. And of course, that plays out in terms of hybrid living and hybrid working. And one way we see that affecting things directly is in the office markets. And this is a big question, what's going to happen to those around the world? So starting with office utilisation, so this is an average of the amount offices are utilised in a week, how busy those places are. No surprise to see Asia Pac much higher utilisation than the West. So particularly North America, we see very sticky hybrid working trends, especially in those tech markets like San Francisco, still well under 50%. Europe sort of hovering around the middle there. Now that's already shaping demand for offices in different markets. It's not the only factor, but it's one factor. So San Francisco here, this is now looking at vacancy rates. This is directly how much office space is available in those markets. And in San Francisco, that's leapt up to in excess of 35%. So before the pandemic, that was less than 9%. So real shift there. China, comparatively high, and that's less about hybrid working, more about supply. But generally, you've got those Asian markets at the lower end of vacancy, so a more positive market outlook there, certainly in terms of offices. Now, of course, this is very nuanced, and we still see strong demand for best-in-class, best-located, green-certified stock. So this chart shows ultra-prime office rents around the world, and we've seen continued growth in those since 2022. So turning to another tech trend, AI, these kind of emerging tech themes that again are driving change in real estate, but also developing new industries. Big topic, not time to cover now, but I'll nod to that. We're also seeing tech shaping economies, and particularly through tech manufacturing. And this is where that sort of geopolitical layer comes in particularly, and with particular relevance to supply chains. So supply chains have seen a lot of change and turmoil in recent years. Back before the pandemic, we had the US-China trade war. Then, of course, we had the pandemic, the various bottlenecks in the recovery, then the war in Ukraine, and we're now in a kind of new era of strategic competition. And this is giving a rise to a couple of key trends, particularly around nearshoring and onshoring. But we're also seeing the rise of the likes of friendshoring. So the US is a good example here. Big investment through the Inflation Reduction Act, and that's provided incentives in investing domestically in clean energy manufacturing, EVs, There's incentives for semiconductors as well, and that's boosting logistics and manufacturing markets in the US. Also in Mexico, we're seeing the rise of friendshoring because it's within the North American Free Trade Agreement. Again, that's driving demand for logistics and manufacturing there. At an Asia-Pac level, I guess the big beneficiary of this is Vietnam, given its comparatively affordable workforce and other benefits. And we're also seeing potential beneficiaries in terms of Malaysia, Indonesia, and India. So these are the forecast manufacturing employment levels. Touching on retail, and again, thinking about trends, this links to technology and the rise of e-commerce. So in the pandemic, we saw a big spike in e-commerce penetration. That's somewhat sort of returned to the long-term trend. And we're seeing this play out in a comparatively positive way in terms of physical retail. So specifically, we're seeing brands move back to those kind of iconic retail locations. We're seeing online retailers opening up physical stores. Particularly in the West, we're seeing a trend of brands moving to affluent local suburbs to tap into people who are perhaps working from home a couple of days a week. And of course, these trends also impact city centres, and we're seeing that real demand for amenity-rich places that people want to spend time in, places with unique experiences as well. Again, specifically with a nod to Asia Pacific, we've seen continued rental growth in the prime retail markets, led by Hong Kong and Singapore. And I think retail is going to remain a comparative bright spot, particularly in Asia Pacific. We've had a lagged tourism recovery in the region, so that boost is still to play out. Household savings remain comparatively high. And although obviously we've got a weaker economic sentiment, that those are going to offset some of those challenges. I think the caveat here, though, is China, where again the supply is quite high. But looking ahead, we expect to see forecast rental growth of up to 5% across the key Asia Pacific markets. So last thing from me, a word on ESG. If we're talking about big things, we can't ignore this one. Real estate accounts for 40% of global carbon emissions, so it absolutely has to be at the heart of any solutions when it comes to climate change. And this is quite a sobering chart. Over the last 50 years, extreme climate events have become 10 times more common. And clearly this has direct implications on our urban environments and our real estate. So one way we've looked at this is looking at climate resilience in cities. So on one hand, we look at a city's climate risk, so whether it has risk of drought, floods, extreme temperature, etc., but also its resilience. So is there a plan in place? How vulnerable is its real estate stock? These are the results. This is a sample of cities, and Singapore on the sort of more resilient side of things. I think the interesting takeaway here, though, is actually particularly some of those US cities which have very high climate risk, lots of physical disasters at play there, but actually offset to some extent by some of the mitigating factors they are taking. And actually, New York's a nice example here. It had Hurricane Sandy back in 2012. That was a catalyst for significant flood infrastructure investment. There's a further 52 billion in the works. Cape Town, of course, famously had its day zero in 2018. It ran out of water. Again, as a result of that, that was a catalyst for big investment in water infrastructure, but also usage policies. And lots in the news around wildfires around the world this year, and Australia is a bit of a leader here in terms of how it's been integrated into building codes through materials design, distances between buildings, for example. So I guess the message here is, all of this has implications for the future location of real estate investment around the world. And that's, of course, just the impact of climate change. There's a whole piece around the role that property plays in terms of contributing to climate change in the first place, where there's building certifications, etc., come in. So to wrap up from me, the near-term outlook is challenging. I think the fact that we have some clarity around where interest rates are headed is positive. And as I say, we expect to see a sort of a pivot in investment volumes next year, which is certainly a positive. I guess, to reiterate, there are a lot of nuances. No sector is the same. Even within sectors, the outlook is different depending on location, quality, etc. And as I set out, lots of big themes at play, particularly ESG. And the thing to finish on is social value. I think if we're looking ahead, the S in ESG, certainly sitting in the UK, this is the topic that's being discussed among sort of investors and occupiers. So one for the radar increasingly next year. With that, I'll hand over to Alan.